You look at the ledger, and the numbers are spectacular. High turnover, major clients, foot traffic out the door. But when the end of the month rolls around and it's time to pay taxes or cover payroll, the bank account is completely empty. Millions of dollars flow into the business, yet the founder is left staring at a screen, unable to trace where that cash actually went. This equation illustrates the root cause of this failure. From day one, business owners are taught a strict mathematical formula: sales minus expenses equals profit. Because profit sits at the very end of the equation, the business owner treats it as an afterthought. You pay the rent, buy the materials, fund the marketing, and hope there's something left. By leaving it for last, that final number almost always fades to zero. Relying on this traditional accounting method ignores human psychology. It traps the founder in an exhausting cycle of generating revenue without actually accumulating any real wealth. The reason this traditional accounting fails is driven by a behavioral principle known as Parkinson's law. This law states that human beings will consume a resource exactly up to the limit of its total availability. If you buy a massive tube of toothpaste, you squeeze out a heavy amount every morning. When it's almost empty, you adapt and make a tiny drop last for a week. When you apply this behavior to a standard business setup, the problem becomes obvious. All revenue, tax liabilities, and operating funds get dumped into one giant chaotic bank account. Seeing a massive balance in that single pool tricks your brain. You see cash, so you authorize bloated expenses, a bigger office, buying unnecessary software, expensive marketing campaigns, assuming the profit will somehow be there at the end. As long as cash sits in a single, unsegmented pool, human nature dictates that the business will unconsciously spend every last drop of it. Financial starvation becomes inevitable, regardless of how much you sell. To fix this, Mike Michalowicz developed a method to hack our psychology by flipping the formula. The equation becomes sales minus profit equals expenses. Extracting profit immediately removes the temptation to spend. Mechanically, that single account is deconstructed into 5 foundational accounts. First, the income account acts as the sole receiving valve for all cash. From there, cash moves to the profit account, establishing an untouchable wealth reserve. Next, the owner's comp account secures a fixed salary to guarantee the founder's personal survival, while the tax account siphons off cash to preempt crippling government liabilities. The final pipeline is OPEX, or operating expenses. This represents the absolute, limited fraction of cash actually remaining to run the business. This segmented architecture mechanically restricts your spending power to the OPEX bucket. It forces financial discipline automatically, long before a single bill is paid. The immediate challenge for a founder is determining exactly how much money to route into each of these 5 pipelines. This chart outlines target allocation percentages for a growing business. Out of total revenue, standard strict slices dictate pulling 5% for profit, 15% for taxes, and leaving around 50%. Strict allocation percentages and twice-a-month batch processing removes the emotion from banking. It transforms cash flow management into a predictable, automated machine. Taking profit first triggers an immediate, intentional consequence. By artificially restricting the OPEX budget, the business is forced into extreme operational efficiency. This requires a shift to a strict, no-debt lifestyle. Vanity expenses must be killed, and the reliance on bank overdrafts or business loans must be completely eliminated. If a business cannot survive on the limited cash remaining in the OPEX account, the core model is broken. The structure requires immediate downsizing, not masking the failure with more debt. Artificially shrinking your operating cash acts as a diagnostic tool. It forces a business to become genuinely resilient, rather than just surviving on a ventilator of borrowed money. Building this entire financial machine leads to one ultimate payoff: the quarter-end distribution. Every 3 months, you extract exactly half of the accumulated profit account. This cash is not meant to be reinvested. It is a mandatory, celebratory reward for the founder's hard work. The remaining 50% stays securely locked in the bank, forming an unbreakable, multi-month emergency reserve to ensure survival during market downturns. Turnover is vanity, profit is sanity, and cash is reality. True wealth is built by abandoning the illusion of high revenue. By taking immediate structural control of your cash flow and paying yourself first, you ensure the business works for you.